Welcome to the Retirement Guide Podcast. I'm your host, George Jameson, owner of Capital Wealth Group, a flat fee only advisory firm. Whether you're nearing retirement or already retired, join me each week as we explore the world of retirement planning and equip you with the knowledge and tools you need for a successful retirement. So let's get started. Today we're continuing the conversation on asset allocation, focusing specifically on retirement. As I mentioned in the previous episode, asset allocation is all about the mix of investments across different asset classes, like stocks, bonds, and cash. In this episode, we'll dive into the details of asset allocation, its importance in retirement planning, and how to figure out if you got the right mix for your retirement goals. Now, when you're thinking about retirement, it makes sense to plan for a good 30 years or more. Let's break it down into 3 steps to help you determine your right asset allocation and generate the growth and income you need in those retirement years. First, we start by setting aside about 1 year of cash. At the beginning of each year, make sure you stash away enough cash to add to your income from annuities, pensions, Social Security, real income, or any other steady sources. Keep this money in a safe, liquid account. Maybe a money market fund would be appropriate, which usually offers better yields than traditional savings accounts. Having this cash on hand takes some of the worry out of the market's ups and downs. You will spend from this account and then replenish it now and then with funds from your investment portfolio. And now part 2, build a short-term reserve. Now let's talk about creating a short-term reserve in your investment portfolio, equivalent to 2 to 3 years or more worth of living expenses. Invest this money in high-quality, short-term bond ETFs. If you prefer hands-on management, you may want to set aside a short-term CD or bond ladder, a strategy where you invest in CDs or bonds with different maturity dates. As they mature, you can use the proceeds to replenish your bank account. You can use the interest income and other returns from the reserve to cover the portfolio withdrawals we talked about in the first step. This reserve acts as a cushion during a prolonged market downturn, allowing you to avoid tapping into more volatile investments like stocks and long-term bonds to generate cash. And now part 3, invest the rest of your portfolio. With a year's cash on hand and a short-term reserve in play, it's time to invest the rest of your portfolio. Align your investments with your goals and risk tolerance. The big picture here is to have a mix of stocks, bonds, and cash investments that can grow, provide income, and protect your capital. What's best for you depends on your age, income needs, financial goals, time horizon, and comfort with risk. And it's okay to switch things up as time goes on. If you're feeling a bit adventurous with risk, experts often recommend a moderate asset allocation in retirement, which consists of 60% stocks, about 35% bonds, and about 5% cash or cash-like investments. If this sounds too daring, a moderately conservative allocation could be more your speed in retirement. This consists of about 40% stocks and 50% bonds and roughly 10% in cash or cash equivalents. And if you're all about playing it safe, a conservative allocation may be your best bet in retirement. This consists of about 50% bonds, 20% stocks, and around 30% cash or cash-like investments. Keep in mind that 30% cash and cash-like investments may include your cash reserves we talked about previously. So based on data from 1970 to 2022, for those who had followed one of these plans, the results in their portfolios would have looked something like this. The moderate portfolio we first talked about, best year was up 31%. The average was up 9%. And the worst was down 21%. The second one we talked about, moderately conservative portfolio, had a best year of 27%, had an average of 8, and its worst was down 13%. And the third portfolio we talked about, the conservative portfolio, had a best year of 23, but don't count on that. The average was up 7. Seems a little high going forward, but that's what the numbers show us. And the worst was down about 10%. The source was from Schwab's Center for Financial Research, with data provided by Morningstar. Now you might be wondering why we're talking about stocks in retirement. They can be more volatile, right? Well, it's all about the growth potential. Historical gains from stocks have helped investors keep up with inflation and taxes way better than bonds and cash. The key is having enough to keep your portfolio in good shape without risking and selling off assets during a market downturn. So keep that in mind as you craft your retirement plan. And now for a quick recap. Number 1, set aside 1 year of cash that you will need from your investments at the beginning of each year. Find a safe place that's paying the best rates. And number 2, create a short-term reserve of 2 to 3 years or more of funds you know you'll need to live on. You can use short-term bond ETFs or build your own bond or CD ladder. And number 3, decide on an appropriate mix of stocks and bonds to invest that meets your needs, your risk tolerance, your time horizon, etc., that you can stick with and rebalance on a periodic basis. And that wraps up today's episode. Hope everyone has a great day. Thank you for tuning in to this episode of The Retirement Guide. If you enjoyed this episode, please subscribe and leave a 5-star review to help others discover the show. For questions, ideas, or discuss your retirement plan, reach out to me, George Jameson, at Capital Wealth Group. Visit our website at capitalwealthplan.com to learn more. Thank you for listening. Stay tuned for more insightful retirement planning in future episodes. And now for the disclaimer. The information discussed in this podcast is for general explanations and education only. It is not tax, legal, or investment advice. Before considering acting on any information heard here, first consult with your tax, legal, or investment advisor. Thank you and have a great day.